The World Bank has projected that Malaysia's economic growth will ease for the next 2 years due to a slowdown in domestic demand. Cynthia Ng joins me now for more on the World Bank's latest economic report. Okay, so still expansion for the economy, but at a slower pace.
That's right. So World Bank is projecting a 4.5% GDP growth for both 2016 and 2017. Now, they cited poorer domestic demand as the basis for slower growth. Now, Malaysia had been walking a fiscal tightrope given the falling oil prices had put a dent in revenue, shrinking the current account surplus, and the weaker ringgit also not helping dampening private consumption, and Malaysians are grappling with less disposable income, and one of the reasons could be the implementation of GST back in April. But then again, GST is necessary for government to diversify and boost its source of revenue. So really leaving a tightrope for the government in terms of boosting growth and also the maneuvering in terms of policy making.
All right, when it comes to policy maneuvering now, the Bank Negara governor, she's always said, yes, our interest rates are currently accommodative, and looking at the potential for interest rate hikes by the US Fed next year, what does that mean? Well,
Malaysia in a way is constrained because Malaysia has a very high household debt, among the highest in Asia. In fact, according to Bank Negara, it stands at 88% of GDP in 2014. So that would constrain the central bank's ability to lift rates, and this is where it gets tricky, right? On one hand, World Bank says they expect slower domestic demand, but Malaysia needs to increase their revenue. So World Bank has recommended that Malaysia should improve its tax measures, including reducing tax exemptions and giving less zero-rated products to the market, as well as expanding the personal income tax base. But by doing so, households have less to spend, in turn cooling consumption further, especially given the household debt is already at a record high. Although this seems like a really tough call for Malaysia, World Bank has some optimistic things to say about Malaysia, saying that in terms of development spending, our capex is looking still quite positive. It expects public infrastructure development to remain strong, and that will help offset the oil and gas sector.
Now, we're going to hear more from World Bank in just a little bit, but we also had MIDA numbers out today regarding the pace of investments for the first 9 months of this year. We're seeing a drop.
Well, not too good. Investments in Malaysia fallen by 27 billion ringgit for the first 9 months in this year, down to only 153 billion ringgit. Now, this, according to the Trade Minister, is due to the softening property market. Real estate investments plunged 64% to just 21 billion ringgit for the first 9 months compared to a year ago. Now, the good news is, however, that nearly all other sectors remain robust, especially manufacturing, which has increased over the period by about 7%.
All right, thanks so much, Cynthia Ng, for the update.